Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So here's the new financial buzzword, folks, that everybody needs to learn. It's called quantitative easing. Quantitative easing is the fundamental reason why prices kind of decline from that level. And you'll hear everybody say once the Fed went to the quantitative easing, which really, if you don't understand it, take a couple of minutes to read this slide. This is the definition of what it is. It's an extreme form of monetary policy used to stimulate an economy where interest rates are either at or close to zero. Normally, a central bank stimulates an economy indirectly by lowering interest rates, but when it cannot lower them any further, it can attempt to seed the financial system with new money through quantitative easing. Quantitative easing is sometimes called printing money, and although the central bank counts it electronically or actually creates the money electronically, so there's not really a printing press, as we come to know. Okay, the central bank has been purchasing financial assets, including treasuries, corporate bonds from financial institutions, and thereby using money it has created out of nothing. The only problem with this strategy are a couple of things. I highlighted one word down here. There are times where this thing could blow up and lead to something called hyperinflation. Let's hope it doesn't. And examples of an economy where this practice has actually been put into place is Japan in the early 2000s. And as you probably all know, Japan's been in almost a 20-year recessionary, deflationary cycle. And so here we are, US and UK, because this is all the bullets we have left in the gun. But when you look at this chart here, now we knew that prices were rallying up into this area and there were sell orders. We had a feeling anyway based on the prior action when price got up here, and yet everyone will say, well, the reason this happened fundamentally, of course, is quantitative easing. And you know what? That's fine. I mean, that only helps out an entry that I have up here because I've made my decision that prices are at this point in time overvalued and that a put option is an intelligent way to speculate on that. Okay? And if I'm wrong, I'm wrong. So here we are, July. The dollar could not absorb the supply near 88 and is sold down to the demand near 80. The Federal Reserve policy, quantitative easing, has been cited as the fundamental reason for the shift in the sentiment of the dollar traders. Now, if the dollar absorbs the buyers at the 80 level, it's probably going to come down to the 73 level support. And that 79 level where we're sitting at right now today on the way back up is going to be resistance. And you know what? My rules are if we base and rally from where we're at right now, I'll buy a pullback. But if we base and drop, I'll short a rally. And really, that's all I can do. I wanted to bring our dollar in review chart, including the gains from 630 of 08 to 630 of 09. We ended up at 19% up against the Australian dollar. At one time, that was a 63% gain. So we talked about hedging this position when it first happened and the spectacular rally that the dollar had last year and how that made sense. Against some of these other currencies, British pound, we've given back more than half. We've given back quite a bit against the Canadian dollar, quite a bit against the euro. But here, against the yen, we gave it all back, and we actually went negative. So I just wanted to remind everybody that fantastic moves sometimes get corrected. And this was our Aussie. This is the brand new chart again. These were very new indexes that just started trading. And while it was in this trading range, the strategy was to trade the range, buy puts at the top of the range, buy calls at the bottom of the range. I didn't put all the slides in from back in June last year, but we had planned for a breakout once prices broke above here to take some kind of a long position using calls. And this is a great reason to use the FX options, the ISE FX options, because in my initial analysis here, the Aussie actually broke out of the bottom of the range, the 104, 107 range, and made a 52-week low of 101.50 before rallying to the 52-week high. So if you used a leveraged Forex contract or a futures contract, you would have had to have a 250 pip stop loss against this move. And there's just no way you can endure with a leveraged product that kind of a drawdown. That will drain your account, especially if you're 100 to 1 or 400 to 1 leverage like some of these Forex brokers give you, the spot brokers. You won't have any trading capital left. If you use an ISE FX option and you buy a 104 call, maybe the position went against you and maybe it would have expired worthless if prices would have stayed down there. But by having that call option as a position, you had a chance to participate in that rally. Again, a lot of that depends on time too. This spectacular rally, after we made that 101.54 low, it happened again in only a few weeks' time. So from 101.50 to 115, a 104 call, even a 107 call, not a bad little trade. Didn't spend very much time basing at all, and just absolutely skyrocketed after that. Now, I don't know how many people come out here and do presentations, Steve, but I'm going to say one thing here. If anybody in this room today thinks that I knew that the price was going to do this, there is absolutely no way that I would have known that could have happened. No way, and I'll never say I could. A lot of people will come in here and say, I predict. And you know what? That's fine. If they want to predict, that's great. But I'm not that smart. All I can do is follow my simple rules, and if the trade works out, it makes money, and if it doesn't, it's a small loss.
Right, limited risk, Steve. Absolutely. I mean, that's the point you just made. We all don't know all the time what the certainty is in the world, but at least you have the limited risk of these options, whether you're trading FX options or any other options.
Exactly. So I wanted to point that out because under no circumstances am I here patting myself on the back. That trade could have been a loser too. If price would have stalled out, it still could have been a loser. Once we did break out there and we actually had that big rally, it did make sense to hedge that position, to use some kind of a protection. And I kind of talked about a trader that's using contracts, futures contracts, Forex. You could use some kind of a moving average for an exit. Or if you happen to be a trader that's using the FX options to protect your position, you could buy insurance by buying a 140 put. But here's the thing now. That's February of this year, and now we've already started to go sideways in a range here for a long period of time. And when we start to go sideways for a long period of time, that hedging gets to be expensive. So what you really want to do is come up with some kind of a strategy as long as you're staying in this range, condor or some other kind of strategy. As long as you're able to map these strategies out and plan for trading in a range like this, why not collect the income as long as you're inside that range instead of buying the protection all the time too? And Steve has guys on here that, I'm not going to spend much time. Steve has people on here talking about this kind of thing all the time. It all starts with understanding, are you going sideways, up, or down, and then making your decisions on your trading based on that. We kind of sold off down here now. We found a little support on the origin of this big move here. I suggested a couple of things that you might want to do if you want to trade on daily charts and look for opportunities on daily charts now that price is kind of in the middle of a 4-stage.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.